For insight, let's go to our featured guest of the morning. He's John Zechner, founder and chairman of Zechner Associates. John, great to have you with us on the final day of the week. Thank you so much for joining us. What's your take on this week's trade? Those comments from Powell were hardly a shock, and yet markets have reacted very negatively nonetheless.
No, you're absolutely right, Paul. But I think the point is that, and you mentioned it as well, I think the Bank of England moving up a half point instead of maybe the expected quarter point. I think what you saw from the ECB the prior week, raising interest rates, obviously what the Bank of Canada has done. So those were sort of sitting on the fence wondering if the Fed was sort of done with, or maybe not believing the prognostications of the last Fed meeting with 2 more rate hikes. I think it's starting to sink in that, yeah, they mean it. They're going to keep interest rates higher for a longer period of time until inflation is under control down to their 2% range. And there's a lot of bullish opinion that, well, look, the inflation has gone from an 8 to 9% range down to 4%, 4 to 5, and it'll get better from there. The problem with that is, a year ago, you had sort of the super high prices of oil and other commodities because of the war. And those coming down has really been most of the improvement in your inflation numbers. The stickier parts of inflation, the service inflation, is still running around the 5% level. That's the part they still need to bring down. That's going to take a little bit more time. So, these guys are far from done. They're going to leave these interest rates in place for a while. Paul, I don't see how we can possibly avoid going into recession. You had a great interview yesterday with Dave Rosenberg, and I would stand right beside what he was saying on that. I mean, when we look at a lot of the front end indicators, we're heading down into this period of sort of no growth or low growth or whatever that will, in retrospect, be defined as a recession. And you're getting more data points. Like some things, people say the economy has less interest rate sensitivity than it used to. I think that's absolute nonsense. I think the reason the economy has stayed stronger for longer because there's so much stimulus already in the system. I mean, all that pandemic money, all that spending, all that monetary ease was still out there. The U.S. is still running what, $1.5 trillion budget deficit. I mean, that's all sort of inflationary. That's all keeps growth going, keeps consumer spending. I mean, obviously they weren't able to spend because of the pandemic for a while. So that's rolling over, Paul. And I mean, look at this morning at those PMI data from Europe and from Asia. They're starting to show the service sector slowing down. So, long story here, Paul, it's the economic outlook. It's hard for me to paint a positive picture. And in that environment, how can you really be bullish about stocks? Now, on the positive side, I think a lot of the cyclical stocks are already reflecting quite a negative scenario. I think the energy stocks are absolutely already acting as if we're in a recession. Some of the consumer stocks do the same thing. It's a very small area of the stock market that has kept the indices higher for the first half of this year, and I think that's starting to break down.
You have provided us with a graph that we'll put up on the screen now that shows a fairly tight, fairly regular relationship between the yield curve, which is the white line on this graph, and recessions, which are the blue vertical bars on this graph. Tell viewers what they're looking at, John, and what the takeaway here is.
Well, that's just basically the shape of the yield curve. I mean, short rates versus long rates. And when it goes negative, it means that short rates are higher than longer term interest rates. I mean, the standard is to have longer term interest rates higher in a normal economy, short rates lower. When that inverts, it's because basically the central banks are trying to slow the economy down, which is reflected in the shorter term interest rates. The longer term interest rates fall because of a more negative outlook on economic growth. And Paul, I mean, anybody can sort of, come onto your show and bring some stats to back up what their own case is. And I, guilty on that count. But what I just wanted one chart that I thought really summed up, okay, when you look at the last 4 decades, I probably could have taken this back 6 or 8 decades and we're showing you the same thing. Every single time you've had an inversion of the yield curve, look at that, the shaded areas after, you've been in a recession afterwards. Why would this suddenly be different this time around? Especially, like I say, since we've had a decade of zero interest rates and people have sort of been addicted to that. To say we have less interest rate sensitivity, I think it's a misnomer at this point. So all this chart is doing is showing, hey, it's worked in the past, it's worked, almost, and it's been almost infallible. Why would it not work now? And like I say, we could all sort of get out our various charts about why backing up our own cases of why you might have a soft landing or no landing or a hard landing or whatever. Now, this is one chart that seems to sum it all up, very simply.
And we have just about a minute left in this conversation. We'll talk about tech stocks in our next conversation, but all of this has led you to go underweight on stocks on behalf of your client, correct, John?
Yeah, we have taken our tech weighting down, particularly because that's where the strengths have been so far this year. I mean, I'm like any other investor. What do you do when you get a little worried? Well, yeah, you take down the value, some of your winners a little bit because, they become a higher part of your portfolio. I'm reticent to sell some of the cyclical stocks. And, guessing market timing is always a mug's game. And I'm not going to really try to do it. All I know is when I look at it, stocks look overvalued right now. And we're heading for an economic downturn, and interest rates are going to stay higher longer than investors expect. Add all that together, and it's probably a good time to be slightly underweight stocks, maybe a little overweight bonds and cash, and that's all we're doing.